This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Thursday morning. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, with me, my colleagues Surabhi and Nigel. Morning, guys.
Morning.
Morning, Prashant. Morning, Nigel. Biggest queue. We're counting down. It's just 2 days now. Penultimate.
2 days to what is the more important question?
The weekend. It's always the countdown.
What kind
to
of a weekend?
The long
weekend.
But it's the last long one in a while.
Yeah, that's the bummer. That's the downside. I'm trying not to think about it.
All right. Well, so starting on a cheerful note, as always, let's just quickly take a look at what the Q's handoff is from Wall Street and the things you need to know as we begin a fresh trading session. It's been a mixed close in the US market. NASDAQ is doing a little better. And that, by the way, has been the stronger index all through this year. It's been tech versus banking. Tech has outperformed banking handsomely from the beginning of this year. Banks, of course, have been roiled with their own troubles. The NASDAQ ended 0.5% higher. The S&P was down about 0.4%. Now, Microsoft, remember, beat expectations. The stock jumped. It, by the way, what it did overnight for NASDAQ was that it boosted a lot of cloud stocks because the cloud business of Microsoft, Azure, has done very, very well. And then you had the Meta numbers, which I think will keep sentiment in the tech space, the broader tech space, very, very good because the numbers are a beat and the stock is up 10-12% post hours in the US. So technology numbers so far, starting with Google, Microsoft, Meta, this is mega tech, large cap numbers out of the US, which have all beaten expectations very well. Now, of course, there is on the other side, you've got the sort of, old economy companies like, for example, UPS, which delivered numbers which were very subpar. For example, the Dow Transportation Index over the last 2 days is down 7%. So there are lots of moving parts here which are going out. But the fact is, I mean, if you just want to see which are the companies with the largest weight in US indices, it's these mega tech companies, mega large cap companies, and they're doing well in terms of beating expectations. All right. Now, for India, the important thing also to note is that oil has seen a very sharp sell-off. Oil prices, Brent, by the way, is down 4% last night. It touched about $77.68 a barrel. This is important to kind of note in terms of the amount of oil. We're one of the largest oil importers, and this is good news unambiguously. On the market here, we once again saw a late push higher. The Nifty ended about 0.25% up. It's not big, but the fact is it's a vast improvement from where we were at open or in the first half of the session. The push came later into the session. In the near term, the levels remain the same. The level to take out and conquer is 17,863. We need to move above it, and we need to close above it as well. 17,863, it's about 50 points away from where we are. Once we do that, targets of around 18,100 come into focus on a successful break of this level. Yesterday's low of 17,711 can be used as a near-term support level. It was a big candle day. The market bounced off. 17,711 can be used as a support. On the Bank Nifty, the immediate resistance, by the way, banks have been the stronger part of the market as compared to the Nifty. For the Bank Nifty, and Bank Nifty, by the way, is trading above its previous high, unlike the Nifty, which is yet to take it out. The immediate resistance is 42,966. It's a number we've put out over the last couple of days. And again, yesterday's low, which is 42,432, where the index took support and then saw a decent bounce in the intraday, should hold for upsides. For potential upsides to remain. I mean, the pace is not 1,000 points in 10 days like what we saw from the lows of March. It slowed down a little bit, but I think it's very clear that buying the dip impulse is very much there, and the market is slowly but steadily sort of moving up 40 points, 50 points, but that's been the kind of market we're in. Broader markets, a lot more action. Single stocks, it's been completely crazy, 5-10%. So many of those stocks moving around over the last few sessions or so. Surabhi.
Prashant, yes, absolutely. I just want to add to the point that you made on the big earnings in the US. While tech obviously has been taking things higher, what's negating it is some concern around banks all over again, right? We've seen those headlines on First Republic. First Republic Bank, by the way, was down another 30% yesterday after falling 50% in the previous session. And all kinds of, permutation and combinations are being speculated upon all over again. Remember, this is the same bank where the top US, the big boys, the big lenders like JP Morgan, etc., they had pumped in $30 billion in deposits to shore up confidence. But despite that, we've seen what's happened. There continues to be a flight of deposits. And now there's a lot of guessing game going on, whether there'll be a bad bank created to sort of carve out the bad assets, whether the biggies will come together to buy this one. So this has again become a talk point on the street, and that's kind of tempering the enthusiasm, which is why even if you see, when the NASDAQ has a life of its own for obvious reasons, but yesterday in the actual session, you saw the Dow and the S&P 500 ending on a downbeat note. Of course, Prashant's already mentioned big tech is the good point. We had Microsoft surging 7% during regular trading. Meta has been surging 10-12% in after hours, and we'll see if we get more of that today when the US market kicks out for action. Back home, I just want to talk about earnings here as well, because the way the market sees it, there doesn't seem to be a major big outlier number that can move the needle at an index level that can really power through a huge rally. We've not quite seen signs of that, not even with Reliance after the earnings. Maruti came out yesterday, and we had a bunch of numbers post-market close as well. Bajaj Finance, yes, the growth is good, but we already had the Q4 operational update. There could be a concern point on the margins. The company's already guiding for slightly lower margins going forward. If you look at others, the life insurers, yes, Q4 was great. We know that because they had the budget pop coming through. The question is what next? And there, if you see some of the brokerages on stocks like HDFC Life, it's a toss-up in the air. There's no immediate clarity on whether FY24 is going to be a major year. Look at Voltas's numbers. Revenues are in line. Huge amount of margin pressure because of higher raw material costs, higher OPEX, etc. So again, the short point is that we don't seem to be getting this mega number that can sort of decisively change the context for the market. We got that in ICICI Bank. We need to see another major one. But even without it, the market continues to march higher. And today is the final day of the series. And Nigel, I guess, earnings aside, something's been moving, because even if it's incremental 20, 30 points here and there, we are very close to the top end of the range.
Well, it's adding to the kitty, right? Those 20, 30, 40, 50 points, and it adds ultimately up. And what a series we've had. Today, we're going to be drawing the curtains on a very, very good series. And you talk about markets giving you some pleasant and unpleasant surprises. Well, this is a pleasant surprise. We got into this April series with the FI's net short. Things were looking a little bit subdued. The last few series haven't been great. And now you're bracing for the best series all the way since October. In October, we gained closer around 5%. We were up 919 points or thereabouts. The Nifty has done very well. The Nifty Bank, that's the one that's really leading the way in this series so far. Buy the dip has worked, right? So I guess you need to stick to that. And when you have global cues a little bit subdued or more or less flattish, you're getting that intraday dip, or even at the start of trade, there is a bit of a dip. The additional positive is we have weaker dollar as well as lower crude prices. Now that works well for an emerging market, particularly like India. What did the FIs do in the FNO market? Well, yesterday they added close to 7 to around 8,000 contracts on both sides, on the long as well as on the short side. On the index option space, they bought more puts than calls. As should be mentioned, there is some fear about a banking crisis that could possibly happen in the US. Hopefully, it's not that deep or that bad. But in case things go wrong, there is some protection on the downside. What's heartening, though, is you're getting into an expiry day with very, very aggressive put writing. And at lower levels, puts were getting written yesterday. 17,800 put, 17,700 put. Between them, there were 80 lakh shares added at both those two strikes, which brings us to the level. The 17,800 put, it ended with a premium of around 30 rupees. But, at some point of time, it was 50, 60 rupees odd. So for those 17,800 put writers, their stop loss comes in at around 17,740. This is positioning getting into expiry day. So that's a crucial support on the downside. We have a whisker away from the 100 DMA. So keep an eye out on that mark. But the highest that we have seen in this series is close to around 50 points away from yesterday's close. So can we end this series on a high? That's the question. The Nifty Bank has been in fine form. It needs to continue. Highest open interest at around the 42,500 put. That's close to around 300 points away from current levels. Pull up the Nifty Bank actually. And writing has been seen at around 42,700 put. The premium yesterday at the start of the day was around 300 rupees odd. So for those put writers as well, they are looking to defend the 42,500 odd mark. SGX Nifty suggesting a bit of a subdued opening. Not too bad. Get a little bit of a deeper dip. And the screen is telling you buy the dip. So let's keep an eye out on that. But though, brace yourself for some volatility in the final hour of trade, given that it's expiry, and it's been a very, very good series for the bulls. Can they end on the high, importantly?
All right, slow and steady, and that's the way the market is panning out to be, which is not such a bad thing. Well, before we go any further, let's quickly tell you what's lined up in the first 30 minutes of on the show today. We get you a quick check on markets across the globe. Dean Kim of William O'Neill and Company will join in to discuss the global setup. Our research team, a little after that, will get you the top 10 stocks to watch for the day based on news flow, results, lots of them. And at 8:30, we do a fundamental stock check with Deepan Mehta of Elixir Equities.
Okay, so that's a power-packed lineup. Let's start off with the equity call of the day, and this one's coming in from Sanjay Mukhema of JP Morgan, who says that he sees two positives. First, a normalizing domestic cycle with lower inflation, job restoration, and end of COVID volatility. Second, he says, is that Nifty valuation premiums are down close to average levels. He also has two concerns. First, that India is still vulnerable to a global correction. And second, a significant portion of the market trades at high multiples without offering higher growth. Sanjay says that JP Morgan largely looks at avoiding the latter and prefers banks such as ICICI Bank, SBI, and Bank of Baroda, and staples like HUL, ITC, and Godrej Consumer. They also prefer TVS Motors and Bajaj Auto in the two-wheeler segment. Healthcare names like Sun Pharma, Cipla, along with stocks like DLF among real estate companies make it to their list. Sanjay says that they are overweight on IT and consumer discretionary.
Okay, some money market views now. Parul Mithil Sinha of Standard Chartered Bank says the dollar INR edged lower on dollar weakness and lower oil prices along with improved macro dynamics. He expects the pair to trade in a range of between 81.25 to 82 to a dollar next week, with likely US dollar purchases by PSU banks probably to cap the floor. Parul says dollar trends will stay the key forex driver, which would likely be led by FOMC decision or any development in the US banking system.
On bonds, Parul says domestic bond rally is tracking global bond and strong auction demand. She says the overnight index swap rate also moved lower on repricing of rate cuts in the next 12 months to 75 basis points from 50 basis points earlier. She expects the 10-year benchmark bond yield to trade in a range of 7.05 to 7.20 next week, with a close watch on the FOMC decision on the 3rd of May. She feels markets are nearly pricing a 25 basis points rate hike.
Well, that's entire market setup, equity, bond calls as well in there. But let's run you through all the stock-specific action that we're tracking for you, and we'll get to that in just a wee bit from now. But we're looking at Bajaj Finance, HDFC Life, SBI Life, L&T Tech, Indus Stars, Canfin Homes, Syngene, and Gujarat Gas. All of them, their stocks on the back of positive news flow. On the flip side, you have Coforge, Voltas, as well as Gujarat Gas, their stocks on the back of negative news flow. I think Gujarat Gas makes it to the red list, so we'll keep an eye out on that one.
All right, stocks with names starting with Gujarat were all the rage yesterday, and we'll have a discussion on that a little later here on the program. Dean Kim, head of global research product at William O'Neill and Company, joins in to discuss what he's making of the overall setup. Dean, great to have you with us here on the program. There's a bit of a divergence in the US, right? I mean, I was just mentioning, while large cap tech is doing very well, and that is responsible for bulk of the, I think, 7-8% gains on the S&P and gains on the NASDAQ, of course. You've got the Dow Transports, which is down almost 7% in the last 2 days. What do you make of what's going on out there in the US and the potential for that to have an influence in other markets, emerging markets especially?
Yeah, certainly. For the US, we were trending fine up until yesterday and to some degree today. The S&P broke below the 21-day moving average for the first time in about a month. And we are on way to test the 50-day moving average, which is like 1% below. And the NASDAQ followed suit as well. However, we had strong earnings reports from Microsoft and Alphabet today, which propelled the market higher. But then we saw downside reversal into the close. And after the close, Meta reported great set of numbers. And so we'll see how the market opens tomorrow. But I think we need to see some improvement in the market in order for us to, get through this market, which is, tagged as uptrend under pressure for now. Sector-wise, as you mentioned, technology, healthcare, staples, select retail continues to hang in there. but energy, basic material, transport, and financials are under pressure. Breadth continues to be narrow, with only 35% of New York Stock Exchange stocks trading above the 150-day moving average. And this was 47% a couple of weeks ago. So we need to see some improvement. And of course, all eyes will be on Fed policy decision next week. And expectation calls for a 25 basis point hike. And I think that's well understood. So either way, in terms of if they raise more or they say we're going to go longer, or if they actually, stop raising rates, we're going to have vastly different outcome in terms of market performance. So next week will be pretty critical.
Okay. Yes, absolutely, Dean. Let me just ask you one more question on the U.S. before we move on. This whole banking chatter is back thanks to First Republic, right? Do you think it can become an overhang or a concern? Or do you think the markets put it behind it and probably realizes that even if First Republic needs to be saved, it'll simply be done and life goes on?
Yeah, I think, SIVB and First Republic, they're in a special situation because they were heavily geared towards tech deposits in Northern California. And I think they are a special situation. Now, if I noticed that a lot of the regional banks have reported, and depending on the bank, stocks have been reacting positively to positive management commentary, despite overall pressure on the banking sector. So I don't think we're going to have a crisis per se in the banking sector. However, we do see some significant headwinds. One is when the Fed starts cutting rates, that's they're signifying that the economy is indeed in trouble. So that's one thing. So we may see recession going forward, and I can tell you that the loan criteria has been ramped up, and I think the demand for loans is going to be pretty low going forward. Second thing is margin pressure. I think we're going to see some margin pressure on net interest margins going forward because of the yield curve. And then lastly, there's still this overhang in terms of commercial real estate in the U.S. So that could be a black swan event. But that's going to, really come out not all at the same time, but over several quarters. So we do see some headwinds, but it's not going to be a major crisis in my mind.
All right. Hi, Dean. Good morning. Dean, the last time we chatted, you spoke about a few good-looking markets. I think India as well made it to the list. But Taiwan, Korea, as well as Hang Seng, those are the markets that you were looking at. In this month itself, India has been an outperformer, mind you. We were slow to start in 2023. But what's your pecking order right now? Do you think the Indian markets are good for more? I recall you telling us about the 100 EMA, which is now in our vicinity. Right. Your take.
Right. Yeah, so India market, we still have it as an uptrend, fantastic market, performing well. We just need that one more day of positive action in the market to get us above the 100-day moving average. We're sitting right there. And next support is the rising 21-day moving. It's actually the 10-day moving average, which is about 1% or less than 1% below, followed by the 21-day moving average. So I am seeing a lot of names in India, setting up and breaking out, which is positive. So breadth has actually improved since last time I was on. I'm noticing a lot of, of course, there's cap equipment names that's always been strong. But financial names are now coming on, as well as some of the consumer cyclicals and staple names as well. Now, compare India with other Asian markets. We have Hong Kong, Korea, and Taiwan as uptrend under pressure. So they are still performing, but a bit of a pressure at the moment. So we need to see some improvement. And then markets like Japan and China, we're waiting for the rally to begin. We're waiting for follow-through days. But certainly India is the best performing market in Asia so far.
Okay, well, we'll hope it stays that way. Dean, thank you very much. Always appreciate you joining us on the show with some quick thoughts on how things are looking. All right, that's a word from William O'Neill. We will take a quick break on that note. On the other side, our top list of stocks to watch out for this Thursday morning. Okay, well, it's time to boil things down to stocks, and our research team is standing by with the CNBC-TV18 list of top stocks to watch out for the day. Guys, good morning, and thanks for joining in. Abhishek, have to start with you. Bajaj Finance, now the Q4 update was in, so we already knew that they're doing, quite well in terms of growth, but margins, I mean, what's your read-through?
Well, the NII growth has been pretty strong, up about 28% YOY and about 4.5% sequentially. So the net interest margin on a calculative basis has declined by 32 basis points. Motilal Oswal was expecting a 30 basis point decline, so largely in line with respect to net interest margin as well. And that has translated into operating profit growth of about 29% YOY and about 5.5% sequentially. Provisions have remained under control, and you have seen lower OPEX this time around, and that is why PAT growth is at 30.5% YOY and about 6.2% sequentially. So both in terms of NII and PAT, it's a beat on our poll. Asset quality has improved. Gross NPA ratio is down by 20 basis point and net NPA ratio by about 6 to 7 basis point. In the conference call, the management has highlighted that they will see a net interest margin compression of about 40 to 50 basis point in FY24. However, they have also guided for loan growth to be much better than their previous guidance. So the new guidance of loan growth is about 28% to 29% for FY24 versus the earlier guidance of 26% to 27%. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, let's hop across to Surbhi, who's here to track a couple of those life insurance companies, HDFC Life and SBI Life. Surbhi?
Thanks so much for that. So HDFC Life and SBI Life both reported a good set of numbers, and that was on expected lines as life insurance players were positively impacted by the recent budget changes. Now let's start with HDFC Life first. For Q4, the company reported an APE growth of 69% on a year-on-year basis. Now this growth should be taken with a pinch of salt, as it was largely due to pre-booking of non-linked policies. The company did mention that 35% of total business in Q4 came from these high-ticket policies. On the back of this, the VNB also saw a growth of 69%, but the margins were largely flat at 29.3%. Their embedded value for FY23 saw a growth of 32%. Now, this growth in embedded value is positively impacted by a 3,000 crore expense due to a merger with Exide Life and a 2,000 crore capital infusion by the promoter. For FY24, management has guided that they expect to continue their VNB growth along with faster than industry APE growth, but the margins will be maintained at FY23 levels. Apart from this, just a few days back, HDFC and HDFC Bank are now allowed to increase stake in HDFC Life, which will remove a technical overhang and aid the FY24 growth. Now moving on to SBI Life, they too reported a good set of numbers. Now remember, this company was least impacted by the budget changes, and despite that, they have reported an APE growth of 10% in Q4. The real surprise in their results is their VNB and VNB margins, which were much better than expectations. VNB was positively impacted due to a decline from their ULIP contribution. They saw a VNB growth of 23% and margins have expanded by 320 basis points, came in at nearly 32%. Their embedded value was up 16%, and that's good growth considering they had a close to 2,400 crores of negative impact from economic variances, largely on account of changes in bond and equity movements. Their return on embedded value was also higher, came in at 23% versus 21% in FY22. For FY24, they are expecting an APE and VNB growth in the range of 20 to 25% and VNB margins similar to that of FY23 levels.
Surabhi, thanks very much for that. But technology companies continue to come out with numbers. L&T Tech reported, Coforge reported, and in the telecom space, Indus Tower reported numbers as well. Rima is here with a wrap-up. Rima.
Thanks so much for that. Let me start with Coforge since it just announced their numbers. Strong top-line performance. Dollar revenue growth 5%, constant currency revenue growth 4.7%. So it's a good number on the top line. Margins and profits, though, have come in lower than expectation. One, there is an exceptional charge of 52 crore. The company was planning an ADR listing. Now they're not because of the market conditions. So there is a provision on account of that. Two, the company has achieved a milestone of $1 billion of annualized revenues. So the company is celebrating and they're handing out iPads to every employee, and that's going to result in some payout as well. So X of that, actually the numbers are pretty good. So that's the reason why your margins and profits have come in lower than street expectations. FY24 constant currency revenue guidance is healthy at 13 to 16%. Let me move on to Indus Towers, where it's not a bad performance. If you remember in the prior quarter, Indus Towers' performance was hit on account of provisions made for Vodafone Idea. But this time, things are improving. Revenues are flat, but EBITDA margins are finally now back above that 50% mark as it used to. Gross tenancies are up 80%. Receivables that they were expecting from stressed telecom players and other vendors have come down on a sequential basis. And the company has said the Vodafone Idea has been paying its monthly billing from January of 2023. And L&T Tech also not bad. Q4 revenue growth has been better than what the street was anticipating, though margins are slightly short. But FY24 guidance is healthy and ahead of street expectations. Back to you.
Okay, got that, Rima. Thanks very much. iPads to employees, I wonder, maybe that drives productivity, happier employees. Anyway, speaking of L&T Tech, we'll be speaking with the management in a bit from now. Amit Chadha, MD and CEO, will be joining us in the next few minutes as well. All right, let's keep it with the numbers. We have Surabhi back with us on Voltas's numbers, where we saw a fair amount of pressure on margins. Surabhi.
This is a disappointing set of numbers by Voltas. Even though the revenue was up 11% in line with the poll, it was a miss in the EBITDA and PAT, which is a disappointment. Now, the gross margins were also lower by 120 basis points, came in at 21.6%. EBITDA was also impacted by higher other expenses and high employee expenses. EBITDA was down 16% and margins have come in at 7.4% versus 10% last year. Their unitary cooling product segment did not do that badly. The segment saw a revenue growth of 13% and profits were up 7%. The company said that they did achieve volume growth despite the weak consumer sentiment. But the market share, however, remains a concern. The market share came in at 21.9%, down 60 basis points from December. Given the increased competition in the segment, market share remains a key concern. The EMP segment saw good revenue growth, but they've accounted for some delay in collections, which have affected their profitability. And engineering products continue to see improved performance, saw a revenue growth of 15%, and the profits were up 37% over there.
Thanks a lot for that, Surabhi. Abhishek is back with us. Abhishek, tell us about Canfin Homes. How are those numbers?
Well, the employee attrition that's been having at Canfin Homes has had some pressure on the disbursals. So the numbers are not bad given the fact that despite the new management coming in or the new MD coming in, asset quality has largely remained stable or has improved actually. So to start with, the net interest margin is at 7-quarter low of 3.37%. It is down about 10 basis points on a sequential basis. The disbursals are down 6.2% YOY and up about 3.85% quarter-on-quarter. Q4 being a seasonally strong quarter, but it has had its impact due to employee attrition that's seen in Canfin Homes. So AUM growth, first time in last 4 to 6 quarters, is below the 20% level, coming in at 18.2% YOY and about 4.8% sequentially. However, the return ratios continue to improve. So ROA is at 2.32%, which compares to 2% in the same quarter last year and about 2.16% in the previous quarter. Asset quality has improved, which is a positive surprise. So it has come in at 0.55% versus 0.64% in the previous quarter. And in terms of NII and PAT, it's ahead of our poll. Back to you.
All right, Abhishek, thanks very much for that. Now, Syngene and Gujarat Gas are the next companies which reported. Ekta has got details on both. Ekta.
Thanks for that. Well, I'll start with Syngene. Good set of numbers. Revenue up 31%, margins 31.6%, profit, which was better than estimates as well. They have also beaten their revenue and profit guidance for FY23. So it was up 23% for FY23 versus a guidance of high teen revenue growth, 29.3% margins versus guidance of margins of around 30 odd percent. Profit up 17% versus guidance of profit in single-digit growth. Now, one of the key products, which is from the animal health space, has helped their numbers, but nonetheless, very strong numbers for Syngene. Gujarat Gas sources have indicated that they have cut prices with effect 1st May for the industrial segment. ISEC has written on this. They have said that they have cut the Morbi industrial prices by around 5 rupees. This is to keep prices competitive with the recent lowering of propane prices. Industrial prices are now at around 39.5 and industrial prices for non-Morbi stand at around 47 rupees per SCM.
Okay, got that. So Gujarat Gas is going to be in focus as well. Thank you, Ekta, for the details there. Let's quickly recap our list of stocks to watch then. The ones that have positive news flow around them are Bajaj Finance, HDFC Life, SBI Life, L&T Tech, Indus Towers, Canfin Homes, Syngene and Gujarat Gas. Stocks with negative news around them are Coforge and Voltas, both on earnings. All right, with that, let's take it to Manisha Gupta and find out what the commodity headlines are looking like. Manisha, the crude headline is definitely very comforting for us, but you tell us more.
Oh, well, absolutely. 4% of decline overnight for the crude oil prices, and we have seen a decline of nearly 7% for this week now. Not just crude, the gasoline prices are trading at a 4-week low. You have heating oil prices also trading at the lowest since Jan 2022. So, yes, overall, the energy basket has seen a decline. And not just crude, you have to look at the coal prices. They have continued to decline. The gas prices trading in the negative as well for this current week now. But the pressure also has been building up for the metals as a sector, with China manufacturing activity remaining weak and the U.S. manufactured capital goods also having seen a decline in March and April. There are now concerns of slower economic growth. So you have copper at 5-week lows, zinc at a 2-year lows, nickel and aluminum trading at a 2-week lows as well. All eyes now on the U.S. GDP first quarter numbers that released today, and then, of course, the U.S. Fed meeting in the next week.
All right, Manisha, thanks very much for that. Oil very much front and center in a good way. We'll take a very quick break here. On the other side, Deepan Mehta will join in to take a few questions on markets. Results, of course, lots of them coming through. We'll ask him how these stocks will react. And later, we'll have the management of L&T Technologies to discuss their fourth quarter numbers. Came out yesterday. Stay with us.
Welcome back. Hope you're having a good morning. Well, the SGX Nifty, the last time I checked, was suggesting that we'd like to pull back a little bit, maybe 20 to around 30 points lower. That's par for the course, one would say, because if that happens, it gives you an entry opportunity. And we know buying on dips has worked. But a lot of stocks to discuss. So let's get in Deepan Mehta, Director at Elixir Equities, who joins us. Hi, Deepan. Morning. Thanks so much for joining in. Well, let's talk about Bajaj Finance. Came out with its set of numbers. Valuation-wise, not cheap, but one of those go-to stocks, right? What's your view on the stock at current reckoning?
Yeah, good morning, Nigel, and thank you for having me on your show. See, at least one can say that if the valuations are rich, then they are justified with the kind of numbers that the company has declared on that kind of a base to grow the business the way it has and deliver best-in-class growth rates with such low levels of NPAs and the highest standards of corporate governance and risk management. So what is missing in Bajaj Finance? Absolutely nothing. So I guess the high multiples are justified. And maybe, there may be better opportunities in the banking NBFC space now that the entire sector is doing well. But Bajaj Finance is like a core holding. You just, if you're invested in it, you remain invested. And it continues to compound its earnings. And at some point of time, the compression in P multiple price to book will stabilize. And then you will see the stock going up in line with its earnings growth, which anyway can be expected to be around 20% on a very long term, on a very longer time frame, even 5-10 years or so. So generally positive on Bajaj Finance. But as I said, I think there may be better opportunities in the NBFC space, which may give a higher return.
Deepan, hi. Good morning, Surabhi here. Like which ones?
Well, see, I think some of the smaller players will be, they are going to grow at a much faster clip. We saw numbers coming from Poonawalla Finance. Those were very, very impressive. And under new management and the fact that they have the Poonawalla brand, they'll be able to raise resources also far more easily and at attractive rates. That's one interesting stock which comes to mind in the NBFC space. We haven't seen the numbers from the microfinance companies like Credit Access. And so I think those also may deliver exceptionally good numbers. Then there are some mid-cap banks like IDFC First Bank, Federal Bank, I think, which can grow at a much faster pace. And the risk-return profile for these small mid-cap companies is far better than the larger ones like the Bajaj Finances and maybe some of the other larger banks as well. Another company which comes to mind is MAS, Mass Financial Services. It's interesting NBFC. And there are many such interesting small NBFC stroke banks which can grow at 30-40% also now that the environment is much better for them and credit costs have not gone up, so a lot of the net interest income increases will flow into the bottom line.
Got that. What about the sort of mid-cap tech companies? Let's take Coforge as an example. Growth is better than expectations, though there is a bit of a margin miss. What happens to the stock in your opinion? I mean, L&T Tech, of course, reported earlier. If you have any thoughts on that as well.
See, Prashant, in the IT space, small is beautiful now. And it's been like that for quite some time. In the last 25, 30 years that I've been tracking IT stocks, it's the first time I've seen that for such extended period of time, mid-cap IT has performed better, not only in terms of financial performance, but also stock price performance. And they're quoting at a premium to large cap IT. And the reason for that is the maturity of the industry and as well as strategies adopted by mid-cap IT companies. So companies like Coforge would have been very aggressive in terms of marketing, in terms of positioning themselves in specific verticals with specific talent and skill set. They have been able to still deliver the growth rate despite there being a crunch as far as tech spending is concerned. And it seems quite apparent now that the tech spending is going to impact the large cap IT much more. Of course, base effect is the real issue behind it. But mid cap IT, because of their various niches, I think is able to generally generate that 15 to 20% type of top line growth. And I think Coforge, with the number that it has declared, at least, it will sustain these kind of earnings multiple and still continue to deliver decent returns over the medium to long term. And we need to get more and more selective when it comes to software because there will be a few mid-cap IT companies which may not do as well. But there are at least a bunch of 4 or 5 high-profile, high-growth mid-cap IT companies which will continue to deliver superior returns, and that's what we need to focus on.
All right, Deepan, stay on. In fact, since we're on the subject, let's actually talk to a mid-cap or tier 2 IT company management. We'll come back to you with more questions. The company in focus is L&T Tech, which came out with a better than expected set of numbers for the quarter gone by. The revenue was actually slightly higher than estimates, but the margin was down about 50 basis points. And the company has given a 20% guidance, that's dollar terms, growth guidance for the next year. Amit Chadha, MD and CEO at L&T Technology Services, is with us. Amit, morning. Thanks for taking this quick call. I'm just going to start with the growth question because not only have you, done better than estimates at 2.9% dollar growth for Q4, the street is wondering where your optimism is coming from because 20% growth in dollar terms you're guiding for FY24, 10% of that is organic growth, and that seems to be above most street estimates. So what are you seeing out there? What are the signs? And they seem to be far more encouraging than what some of the large cap companies have reported.
Sure. So thank you so much for having me with you today. So I do want to just reiterate a couple, 3 things that we've been able to achieve this year. Number one, we crossed the $1 billion run rate, which was a milestone for us. Number 2 was that our profits were 1,170 crores. So we crossed the 1,000 crore mark there, and the profits were up 22% year on year. And if I look at patents, which we pride ourselves for because we are a technology company, we've crossed the 1,000 mark with 1,090 patents. So all 3 achieved, if I may. Now, if I look forward and I look at, where we see the optimism coming from, like you're talking about. So one, we do see spends in the US and Europe towards energy transition and electrification. Second, we do see spends in digital transformation to be continuing. The market actually is supposed to go from about $800 billion to about $1.4 trillion by 2026, led by cybersecurity, AI, hyper-automation, enhanced speeds of connectivity rolling out, better computation, as well as cloud adoption. Third, we've been seeing in the market that there's a lot of companies that are looking at costs in a very, very strong manner, and therefore offshoring, outsourcing of product development, product sustenance, etc., is there, and we are therefore very comfortable with the guidance that we've provided. We've said 20% plus, and we will continue to provide an update to the market as things progress.
All right. Hi, Amit. Morning. Like your optimism on the top line growth, which is good. I think part of this will be attributed to SWC as well, which comes totally into your fold for FY24. So we've got the, the top line growth. Let's talk about a couple of other aspects. I'm reading a few brokerages and they say that margins, well, they'll see some bit of compression. The EBIT margins from around that 18.5% odd because of the SWC integration. Could you tell us what is the number we should be working with on EBIT margins for FY24, point number one? And receivable days, I think it's at around 95 days approximately for the past year. Now, because of this SWC acquisition, that as well is likely to go up. So give us guidance on both those. As a reference, some brokerages are factoring in EBIT margins to come down by around 100, 150 basis points and receivable days to go up by around 20 days. Your take.
Okay, so two things here. One, on the EBIT margins, I do want to step back, right, and bring your attention to the fact that about 2 years ago, as COVID hit, we had gone down to 14% odd EBIT margins. We have taken the company from 14% odd EBIT margins to 18.x over the last 2 years. So we have an operational playbook that we have with ourselves that we've been able to leverage and improve margins quarter on quarter, year on year, right? Yes, with SWC coming in quarter one, with the amortization, etc., all the expenses put together, we've guided in the 17% range is where we will be for the year and the quarter as we move forward. And we have an aspiration to get back to the 18% levels in the first half of FY26. So that's as far as the margins are concerned. Our DSO, bill DSO came in at, the total DSO came in at about 90. And I would say that combined, we may go up to about 115 odd days as we move forward. But the focus will again be using the operational playbook that we have perfected to leverage that and take that forward to provide stuff sooner. If you remember, when we came back, when we did the acquisition, we'd actually guided 180 to 200 bips lower, but we've slightly been able to improve that when we came in with the 17% range back in terms of the EBIT guidance.
Got that. Mr. Chadha, we have all the numbers and you've outlined them for us very well. Morning, Prashant here. Just a sort of a question qualitatively. So there are lots of forecasts which say that macros will worsen later this year. Now, ER&D spends are largely discretionary in nature, at least that is what the general perception is. In such a scenario, is it possible that we see severe cutbacks? And specifically, auto ER&D is about 30% of your business. Is that if macros were to slow down, were to worsen, is that going to be a tailwind or a headwind?
So number one, as when macros worsen, right, there is an immediate impact that does occur, to be very clear, in that particular month or that particular quarter. But you will realize that people will continue to take products and improvise services as they move forward, number one. Number two, there is a clear direction of electrification and energy transition that is happening, that is showing up in automotive, in trucks, buses, off-highway vehicles, industrial equipment that is all being electrified. Those spends are not stopping. While we have seen cutbacks on ICE engine development and maintenance, diesel engines, etc., we are seeing expanded, urgent spends being made towards hardware, software, mechanical, electrical skills in the electrification area. So not just limited to auto, but aerospace, hybrid aircraft, to trucks, off-highway and buses like I talked about. So I do believe that I can definitely see that as a 3-year cycle in terms of expansion. So that's number one. Number two, in terms of digital, the color of digital has changed. 3 years ago, spends in digital were largely coming out in connecting devices. Today, that connecting devices is done. It's all about collaborative computing. It's all about artificial intelligence. There's a lot of talk about ChatGPT, as you've seen in the media, and otherwise as well. I do believe that spends in hardware, software, firmware will definitely go up, and we are seeing that impact positively in our business. And as these digital skills, including cybersecurity, get up to brick and mortar industry, which is actually about 70% plus of our business today, the brick and mortar continues to spend to fortify their operations, do more automation, etc. So I'm fairly comfortable there. Third point is that whenever there are macros that weaken, there's a laser sharp focus on doing stuff offshore in India. And that again bodes well for people like us.
Okay. All right, Amit, thanks so much for stopping by. I think you're sounding fairly optimistic as well. Environment is a little bit challenging, but good to hear your optimism earlier today. We look forward to having a chat with you, a longer one that is, later in this quarter itself. Have a good day. Well, time to slip into a short break, but on the other side, we'll have Anuj who will be joining in. Well, he'll get us his take on the market, and our technical experts as well will be back with us. You stay with us.
Okay, welcome back. We are just counting down to the pre-open session, which is about 9 minutes away. Let's get you the technical experts and their views and thoughts. Mitesh and Sudarshan are with us as always. Gentlemen, good morning. Good to have both of you here. Mitesh, let me start with you. Once again, opening similar to what was being indicated yesterday, flattish, slightly lower. Will we see a repeat of what we've seen, slow and steady, and a push higher in the last hour?
Well, that's a difficult guess, Prashant, but I think, the idea should be to wait for the markets to clear 17,850, 860 zone. I think once that happens, then I think you are, you have a much better path to move forward and upwards. And then you can look at a test of around 17,980, 18,000 plus level. So I think till then, as long as you're getting this kind of intraday dips, use them to buy into the markets. I think today, anything closer to about 17,750, 17,740 would be my buying zone with the stop below 17,680. And once we clear 17,850, then I think 18,000 should be the immediate target. So world trend is healthy, still on the upside. But yes, I think, till we clear 17,850, there will be these kind of minor volatility kind of periods.
Okay, all right, got that, Mitesh. Sudarshan, what about you? How do you approach trade?
Yeah, good morning. See, 17,600 is the point from where the markets turn back on the upside. That's our support zone. So far as the Nifty is above 17,600, we are in the zone that is controlled by the bulls. Now, every day, every minute, the market cannot go up and it will not. And I have also explained, and I say that again, that this rally which we are seeing will continue, but it will be fairly choppy. It will be a little up, down, sideways, but eventually the direction is up. So in that sense, traders should be positioned on the long side, waiting for dips to enter, and you'll get plenty of dips.
Okay, so wait for the dips and then buy them. That seems to be Sudarshan's call. Gentlemen, good morning. So let's boil this down to stocks. Mitesh, your picks, and also throw in a word on Bajaj Finance, if at all you think you see a trade there.
Yeah. So I'll start with the picks. Today, I think, after a long time, I have a mix of buys and sells. On the buying side is Jumble Fertilizers with the stop at 277 for targets of 299, and Berger Paints on a mild decline, stay around 600, buy with a stop at 590 for targets of 625. MCX though is a sell with a stop at 1416 for targets of 1350, and Tata Chemicals is sell with a stop at 947 for targets of 900. And on Bajaj Finance, actually the stock is just showing signs of a reversal on the upside. So in case you get a dip to about 6,000 odd levels, enter long positions with the stop below 59.30, and I would look at a target around 6,200 if you give it a week and a half.
All right, Sudarshan, what about you? What are your trades?
Well, even I have Jumble Fertilizers in my buy list with a stop under 273. PFC is a buy. It's in a strong uptrend, making higher highs, higher lows. It's currently having a small correction that should get over soon. Buy with a stop under 157. Astral is an intraday short. The stock has been falling even when the market was rising. It's an intraday short with a stop above 1400. And finally, TCS is giving the sense that it went and touched a lower low, but bounced back, which means it was testing that previous low and finding it that successful. So a successful test of the low is always a good idea for good quality stocks. Buy TCS with a stop under 3074.
All right. Thanks a lot, gentlemen, for joining in and giving us your calls. We'll come back to you for a few more picks later on in the show. Let's take a short break. When you come back, we'll get you pre-market opening, and also we'll be joined by Vandan Hari of Vanda Insights to talk about the overnight fall that we've seen in crude oil prices.